Welcome back to ZBCN Today, the channel where we cut through the noise and focus on what actually matters. What if the biggest mistake investors are making right now is assuming that this is already the bottom? What if history is quietly suggesting that the real pain hasn't even started yet? In crypto, emotions move faster than logic. When price drops, people panic. When price pumps, people celebrate. But if you zoom out and actually study previous bear markets, you'll notice something incredibly consistent. Bitcoin moves in large macro waves, and those waves don't end just because we want them to. Today, I want to step back from the noise, forget the daily candles, and really compare previous Bitcoin bear markets to where we are now. And then we're going to transfer those insights into the altcoin market. Because whether people like it or not, altcoins follow Bitcoin. Always. The macro defines everything. Everything you hear on ZBCN Today is for educational and informational purposes only. Nothing in this video should be considered financial advice, investment advice, or a recommendation to buy or sell any asset. If you look at Bitcoin's long-term structure on a logarithmic scale, something very interesting becomes obvious. The early cycles were violent, absolutely brutal. The 2014 bear market wiped out enormous amounts of value. If we were to experience the exact same percentage decline today, Bitcoin could theoretically fall toward $18,000. Now, realistically, that kind of collapse is less likely because Bitcoin today is not the same asset it was back then. The market cap is larger, the infrastructure is stronger, institutions are involved, liquidity is deeper. So expecting the exact same level of destruction might be too extreme. Let's move forward to 2018. That bear market was still devastating, just less extreme than 2014. If the 2018 percentage drawdown repeated today, Bitcoin could potentially fall toward roughly $21,000. Still painful, still shocking, but again, slightly less severe than before. Now look at 2022. That bear market, triggered by massive collapses like Terra and FTX, saw Bitcoin fall more than 75%. If we applied that type of decline to the recent highs, it would suggest a bottom closer to the $30,000 range. Notice the pattern here. Each cycle has seen slightly smaller percentage drawdowns. The pace of decline is often similar, sharp, emotional, relentless. But the final bottom tends to form higher than the previous catastrophic scenario. What does that imply today? It suggests that ultra-bearish targets like $20 might be too pessimistic, but at the same time, assuming we bottom right here could be overly optimistic. A realistic scenario could involve a deeper flush, maybe 35K, maybe even low 40Ks, before a true structural reversal begins. And historically, markets don't bottom when people are still debating whether it's a good dip to buy. They bottom when people give up. Right now, most long-term holders who bought Bitcoin below $70 are still sitting on profits. That's important, because true bear market bottoms usually happen when the majority of participants are underwater. When fear isn't theoretical, it's personal. When portfolios are deeply red, when social media goes quiet, when nobody wants to talk about crypto anymore. If we look at realized price, which represents the average cost basis of the market, it currently sits well below the current trading price. That means the average investor is still in net unrealized profit, and as long as people are still sitting on profit, there's still supply that can hit the market. There are still participants who may decide to take gains if uncertainty increases. Historically, real bottoms form when realized losses dominate realized gains, when the market experiences maximum emotional exhaustion. We are moving in that direction, but we are not fully there yet. That's why calling this the confirmed bottom feels premature. Now let's talk about dominance. Bitcoin dominance rising means Bitcoin is outperforming the rest of crypto, or more precisely, it is declining slower than altcoins. In risk-off environments, capital consolidates into perceived safety. In crypto, that safety is Bitcoin, not because it's safe in traditional terms, but because it's the least risky asset in a risky asset class. Ethereum dominance, on the other hand, has been weakening, and this is where it gets uncomfortable. Ethereum is often treated as the safe altcoin, but relative to the broader altcoin market, it still shows room for downside. When you compare Ethereum's valuation to the rest of the market, excluding Bitcoin and stablecoins, there is still negative momentum. Could Ethereum drop another 30–40% relative to smaller altcoins? Yes, absolutely, especially in a true bear phase where sentiment overshoots fundamentals. And then we look at other major altcoins: XRP, BNB, Solana, Dogecoin. Historically, when macro turns bearish, most of them don't just fall, they fall harder. Solana especially has behaved like a leveraged bet on the crypto market. In bull phases, it explodes upward. In bear phases, it collapses aggressively. Meme coins tend to suffer when liquidity dries up. High inflation tokens face additional pressure because new supply constantly enters the market. The key question in a bear market isn't what will go up, it's what will fall the least. Because if Bitcoin drops another 40%, many altcoins could drop 60–80%. That's not dramatic, that's historical precedent. Many investors underestimate how much macro conditions dictate crypto. When Bitcoin experiences a 70% drawdown, almost every portfolio gets crushed. It doesn't matter how strong the narrative is. It doesn't matter how promising the roadmap looks. In a liquidity contraction, correlations go to 1. We've seen it before. During major collapses like Terra and FTX, Bitcoin fell more than 75%, and altcoins suffered even more. These aren't rare events. They are part of crypto's structural volatility. Some people believe in strict 4-year cycles. Whether that's perfectly accurate or not, one thing is clear: crypto moves in powerful macro waves. Ignoring those waves is expensive. So instead of trying to predict exact tops and bottoms, what if we simply reacted to trends? One of the simplest tools historically has been moving averages. When Bitcoin trades above a long-term moving average like the 200-day, the trend is typically bullish. When it trades below, conditions are usually bearish. But here's where it gets interesting. Backtesting different moving average durations shows that certain lengths, particularly around 125 days and even shorter around 44 days, historically produce stronger risk-adjusted returns than simply buying and holding through every crash. Shorter averages react faster but produce more signals. Longer averages are smoother but slower. Neither predicts the future. They simply respond to trend shifts. And historically, avoiding the deepest parts of bear markets dramatically improves long-term performance. Because here's the reality: if you avoid a 70% crash, you don't need a 10x altcoin to recover. Capital preservation is underrated in crypto, but it's powerful. Right now, many people are asking which altcoin will explode next. But that question might be premature. In a weakening macro environment, focusing on aggressive altcoin bets can be the highest risk decision. Sometimes the smarter move is patience, waiting for consolidation, waiting for volatility to compress, waiting for confirmation that trend has shifted. Historically, bear markets have lasted longer and gone deeper than most participants expect. Buying every dip works in bull markets. In bear markets, it can drain capital slowly and painfully. The market doesn't reward excitement. It rewards discipline. When we compare 2014, 2018, and 2022 to today, one pattern stands out. Each bear market has been slightly less severe, but still extremely painful. We are likely not at maximum pain yet. Bitcoin dominance is rising, signaling risk-off behavior. Ethereum and many altcoins still show potential downside, especially if macro conditions worsen. The real battle isn't finding the next coin to moon. It's understanding the macro wave and positioning accordingly. Crypto moves in cycles of expansion and contraction. Ignoring that structure is costly. The question right now isn't, is this the bottom? The better question is, are we respecting the trend? Because in crypto, trends don't care about hope. They only care about momentum. If you're getting value from this kind of focused, fundamentals-driven ZBEC content, make sure to hit the like button, subscribe to ZBCN today, and turn on notifications so you don't miss future updates. It directly supports the channel and helps this research-driven community grow. Drop your thoughts or questions in the comments. I read them all. Now, let's continue with the real analysis.